Bueno, creo que ahí se van sumando. Bueno, vamos a arrancar, siendo 12:35 hora de Uruguay. Bueno, bienvenidos a todos. Muchísimas gracias por participar de este webinar que hemos titulado Mercados Emergentes Frontera, las oportunidades y los desafíos asociados, ¿no? Mi nombre es Diego Stella, para los que no me conocen. Soy vicepresidente de la Society y de CFA Society Uruguay, que es coorganizador con Colchester Global Investors de este webinar. Bueno, Colchester ha trabajado estrechamente con FTSE Russell para ayudarles a lanzar el primer índice que define y sigue los bonos gubernamentales de los mercados emergentes, frontera, en moneda local, países como Costa Rica, República Dominicana, Egipto, Kenia, Nigeria, Vietnam, entre otros. Y para nosotros es un placer ser coorganizadores de este evento. Para los que no conocen, Colchester es una compañía global que tiene asset under management arriba de 40 billions. Es una compañía que ofrece servicios de administración de portafolios de renta fija, principalmente para instituciones. Y ahora en este día nos acompañan, tenemos el placer de que nos acompañe con nosotros Analía. No voy a leer todos los currículums, Analía y Mark, que son bastante extensos, por cierto, así que les agradecemos mucho a ellos también que estén con nosotros hoy. Analía es Product Specialist en Colchester, y Mark es el Investment Officer y Portfolio Management. Así que bueno, sin más introducciones, algunos housekeeping breve messages que tienen que ver con: nosotros vamos a hacer una presentación, bueno, Analía y Mark van a presentar por alrededor de unos 45 minutos aproximadamente, y después tenemos unos 10 o 15 minutos de preguntas que surjan. Ustedes pueden, digamos, proponer sus preguntas a través del chat que tienen todos ahí en la plataforma, y eventualmente nos hacen llegar ahí las preguntas y vamos a leerlas al final. Así que bueno, sin más, I switch to English. Thank you very, very much, Mark, for being here with us, with CFA Uruguay, and Analia also. So please, Analia, go ahead. All yours.
Bueno, muchas gracias, Diego. Muchas gracias por la introducción. We have recently celebrated a year of collaboration with the CFA Society, so I wanted to give a special thanks to Barbara, Sofia, and the team for all the support during the past months. We have been striving to bring you topics that are relevant to the members, and today is not anything different. Actually, we're bringing you the things that we have been working over the last few months on the emerging market side. We will be discussing our latest work with FTSE Russell to launch the first index that is going to be defining the emerging markets frontiers on the sovereign side. And we will debate the merits of the asset class. So we will see what are the benefits and what are the potential challenges offered in this space. So you made a brief introduction, Diego, to Colchester, but for those that are new to Colchester, just in terms of background, we're a UK asset manager. We manage in excess of 42 billion, and we have an exclusive focus on sovereign. So within the sovereign space, we do cover developed markets, emerging markets, and inflation-linked bonds. And we also look at currencies. So typically, our portfolios and our strategies would be a blend of bonds and currencies. With me today is Mark Capstick. He's a familiar face to many of you. He has been leading the project on the frontier EM side within Colchester, and he will be covering the macro of these countries and the valuations on offer. Mark is based in London. He's part of the portfolio teams of managers that are based there, and he has ample experience in emerging markets. He worked for many years within the asset class, and to be noticed, he was part of the team that set up the first local currency Asian bond fund in the early 2000s. So if we go back to the first question that we will be posing or we will be addressing today, is the definition of what constitutes emerging markets on the frontier side, if we go into the sovereign space, and how FTSE Russell has defined that index. So if we move into the presentation, broadly speaking, we can divide the EM universe in two big blocks. On the one hand, we have the hard currency space, and then we have the local currency space. So subsequently, within the asset class, we can look within the EM spectrum between the traditional, more consolidated emerging markets, all the way through to the smaller, less liquid frontier markets. So if looking just at this depiction of the EM world, the first segment to receive attention and to be defined and tracked was the hard currency larger EMs. So we have there the JP Morgan EM bond index, which was launched in the early 90s after the issuance of the first Brady bond. And if we keep on the bigger, more consolidated markets, the likes of Mexico and Brazil, on the local currency side, you can see the JP Morgan GBI EM Global Diversified Index, which was launched in June 2005, but has historical data going back to 2002. So within both indexes, we have a long-term track record, and they are tracking really the most established and liquid issuers within the space. Now, if we move into the blue end of the equation, that is the frontier markets, we have on the hard currency side, the JP Morgan Next Generation Markets Index. This is a subset of the JP Morgan EM Bond Index, and it was launched in 2011 to track the smaller EM hard currency issuers. Keeping on to the blue and going to the subject of our presentation today, if we move then into the local currency side on the frontier issuers, we have the new index that has been launched, the FTSE Frontier EM Government Bond Index. And this came into life in April 2021 with a track record that goes back to 2017. So clearly what we have seen is a progression of the asset class as it has expanded and deepened over the years. We have seen a growing interest in defining and tracking the sub-asset classes in a more granular sort of approach. So moving on into the next slide, please. If we go into the index on the frontier markets on the sovereign side, so we define this as the FTSE Frontier Emerging Markets Government Bond Index. And we have two versions of this index. So we have a market value weighted index and a 10% capped. The country inclusion in this index is going to be reviewed twice a year. So we're going to be looking at, FTSE is going to be looking to which countries incorporate or not on March and September as part of the FTSE fixed income country classification process. Now, what does it take to make it? What are the rules to be included in this index? So briefly, without going into too much detail, the minimum market size has to be 5 billion nominal amount outstanding. So right now, Serbia is the smallest market to be included in this index. The maximum credit rating is BBB- from S&P and Baa3 from Moody's. So clearly, we're looking at a high yield asset class. Countries that are classified as high income by the World Bank are excluded, and bonds must have a fixed rate or a zero coupon and a minimum maturity of a year. So roughly those are the rules to classify within this frontier market index. The index is priced daily and is going to be rebalanced on a monthly basis. Now, what does it look like? We have it in the following graph, and we have the two versions there. So on the blue side, you have the 10% cap. The gray one is the market value weighted. So clearly what you have on the 10% cap is greater diversification on the countryside. So the larger issuers, or the ones that have a higher market cap, Egypt, Morocco, and Vietnam, those get redistributed on a pro rata basis when they get capped at 10% towards the rest of the country. So you have higher allocations in the capped index to the likes of Costa Rica or Dominican Republic than you would otherwise have in the market value weighted one. And lastly, if we look to the characteristics of the index, which I think is quite relevant to introduce Mark. So we're looking at a space here where the average coupon is about 10% and the yield to maturity is 8%. So if we look at those figures on an absolute term and we compare them versus the developed market world, obviously we're looking at an asset class that potentially looks quite attractive. But there are challenges here, and liquidity and the macroeconomic dynamics of some of these countries come into the equation. So that's what Mark is going to be discussing, as well as evaluations. Obviously, the track record, we said this has a base data going back to 2017. So the max track record here on the index is 3 years. So it's not a very, very long track record as the one we saw on the hard currency space. Having said that, then let me introduce Mark, and thank you all.
Thanks very much, Annalia. I just needed to find a way of unmuting. So hello everybody, and I wanted to express my thanks specifically to the CFA Society. Again, Diego, Sophia, I know Barbara maybe not on the line today, but again, thank you to Barbara, and also to FTSE for the collaboration in terms of the construction of the index, and of course continuing to develop the asset class in which we're looking at today, and of course looking into the future. So I'm just going to try and find the presentation again and bring that to the screen. Okay. And I did find a way of making that larger. Okay, great. So I think just to start, I think actually Annalia has just introduced the index, and actually what the index has done for us as asset managers and interested parties working within the emerging markets is really help define the local currency frontier market space as its own unique asset class. But what I wanted to do today was to really take us down the road as to explaining what frontier markets actually are and what we can expect when we're looking underneath the lid, looking into the tin and looking to see what is in the frontier market tin, and also help explain perhaps some of the benefits and some of the risks of investing within the asset class. So there's a lot going on in there. But I think the first point for an investor, of course, you do get an enhanced return by investing in this asset class, and certainly that is something that you would probably want to expect. Obviously, this asset class is quite illiquid, so there are premiums attached to the asset class, and that a potential extra return is something that is of major interest. On that second bullet point, in terms of diversification and as a diversifier, we will see within the asset class actually one of the most significant attributes of the asset class is the low volatility and the correlation benefits of the asset class. And I think this really does stand out compared to many of the fixed income asset classes, and as a way of some people maybe looking at the asset class as a diversifier to their portfolios. And the next bullet points are really just on the development of this asset class. Really, what happens when countries are introduced into index? That means actually there are a lot more people looking at the individual countries, and actually the ESG work that we do actually when we're speaking with sovereigns helps the macro stability, better policy making, and actually this is something that helps markets development in the future. So this is something that I think speaks a great deal to ESG. And also we would expect to see many of the countries that are entering this universe is obviously the balance sheets. They are weak, but we do see these balance sheets already increasing through time. They're getting better, stronger. What that means on the ground is actually the people who live in those countries have a better lifestyle, better living standards as a result of that. And actually, I would think maybe slightly as a slight difference to emerging markets, these markets are actually moving very, very rapidly. They do have high rates of growth. So I think it's actually just a holding ground, perhaps an incubator for countries that are just about to migrate into the emerging market universe. So actually some of the countries who are coming into this asset class today may quickly shift into the emerging market universe. And I think that's something that's great to see within the financial markets. So maybe just a few things on what you might try and see when you're looking at the frontier markets, what the typical things that you do find when looking at the balance sheets, for example, is that economic standards and ESG standards are significantly lower. They're a lot lower than the markets that you would find in the emerging market local currency universe. And that's because there isn't as much income, and you can measure, of course, income in many different kind of ways, but GDP per capita is probably the most relevant. And you can see at 6,000 on the average country that we're looking at is a long way behind the advanced economies at 46,000. So obviously a lot poorer, and with that standards and other ESG factors are also a lot weaker. On the next few points that I have on the slide, actually we're going to look at that in more detail in the next slide. So I think I'll move on and maybe just look at some of the factors within the balance sheets and compare the numbers that we're seeing on average over the last decade, and compare those to the decade from 2000. And you can quite clearly see that there has been some improvements, but actually the rates of growth that you typically see in the frontier markets are obviously a lot higher than you typically find in the advanced economies. So that's probably one good feature that you would expect from the frontier markets. However, when you're looking at other sort of factors, things like inflation, and of course, people who know Colchester very well, we're very interested in inflation in the way that we look at markets. But it is worth noting that inflation is endemic in a lot of these countries. And of course, looking at fiscals, and this is very important for developing markets, you can see those fiscal deficits are significantly weaker than you do see in the advanced economies. And of course, they've actually got worse. So what that means in effect is that some of these developed markets need capital. They need us to invest in them to cover some of these spending and development expenditures that they have within the market. So what are those expenditures? Well, it's the real things that help people improve their lives. So bridges, ports, airports are needed within these countries. Clearly, they are developing, and that's why they have greater spending needs. And then moving on there, I think that potential weakness that we've already described in the slide before, we can have a look at the debt positions of these markets. And actually the frontier markets have quite a good debt standing. They have an ability to be able to potentially increase the amount of debt. So you can see their levels of government debt is significantly lower than you see again in the advanced economies, less than half. And it doesn't matter which way you look at it, it's on the gross government side and the net government side. But I think one thing to really note and stand out is the net external debt. In other words, their indebtedness on their foreign debt is very, very low. And what that does mean is that the balance sheets do have some support there. They haven't gone out and spent borrowed money overseas to a great extent, which that does mean that their overall balance sheets are a lot stronger for that. So maybe just moving on to the markets themselves and some of the attributes that you could find within the frontier markets. And clearly fixed income government debt, you would want to know what type of yields that you can find in those markets. And Colchester, we're known for forecasting inflation and looking at real yields. But on this page, we thought we'd look at 10-year government bonds in each of these markets and then try and find the real yield using known inflation. So actually the standout on the page is probably the lower blue line, which is the US Treasuries. And of course, inflation currently at the moment is above 5% in the US, which has driven down the valuation, if you like, or the real yield of US Treasuries. So that's why you can see the steep fall in the yield, the real yield in the US treasuries. But behind that, of course, global markets, that is the global developed markets universe, you can also see have negative real yields at the 10-year point. These are high quality markets. And then above that is the emerging markets, the average real yields using today's inflation, which is significantly different if you're using forecasted inflation, which is somewhat lower than today's rates. And then finally, you can see the real yields that are on offer today in the frontier market. So at 3.3%, although perhaps lower than the long-term average, is significantly higher than the developed markets and including the emerging markets. So I think it's worth just looking at some history, the historical returns that are associated with the frontier markets, and then comparing those again to some of the major fixed income asset classes. So here we include the high yield universe, corporate risk in the US, for example, and we're using index returns based in US dollars. So that is unhedged in US dollars. And quite clearly from this chart, you can see frontier markets. The history is reasonably short. The FTSE have produced their index. It launched in April of this year, and they've managed to backdate the performance of these markets back to 2017. So we are doing what we can. We're comparing the returns from the asset class compared to these major asset classes, and quite clearly, the frontier markets has historically given a much greater return in US dollar terms. On the next page, though, I think this is actually one of the key features of the asset class, and we're looking at volatility, again, using unhedged dollar returns of each of the asset classes that we can look at. And of course, the frontier markets have the highest returns, but actually they have near to US Treasury rates of volatility. And this is remarkable if you consider that this is what you would consider a risk asset class. But some of the reason for that lower levels of volatility could be one, the price discovery, in other words, the pricing of the debt and the currencies that we're looking at here are perhaps not as frequent and regular within the frontier markets. And I think it's worth noting that some of the currencies within the universe are soft pegged to the US dollar. In other words, the volatility of the currency compared to the US dollar is a lot lower than you would expect. Perhaps if you compare that to the emerging markets, which is more than double the volatility of frontier markets, I think this is actually a remarkable feature of the asset class. So I think we could potentially come back to that on the next page. Correlations, we can compare the correlations of the frontier markets compared to the major asset classes in which we've looked at. Clearly, a negative correlation from US Treasuries is fantastic. This is great for asset allocation, but you do see a lower level of correlation, of course, to the developed markets, and noticeably higher correlations to risk assets. So, of course, you could deem the frontier markets as a risk asset class, and not surprising to see higher levels of correlation there. So again, just like the lower levels of volatility that we've seen, lower levels of correlation, again, will help people with their asset allocation decisions. So in terms of the, that was a kind of the benefits, but actually some of the risk features, I suppose, of the asset class. The first thing that we have to talk about is market illiquidity. It is a very strong feature of the asset class. And quite clearly, that illiquidity does increase at times of significant risk. So there is specific risks to the individual countries that we're looking at within the universe. So we would call that idiosyncratic risk. But of course, when there's global stress, so for example, last year in the middle of the financial crisis or the coronavirus crisis, you would expect that illiquidity does dry up, and that is a significant feature of the asset class. Capital and capital account controls is, again, another feature, probably noticeably in countries like Nigeria, there is a list for a first in, last out list of for investors who are wanting to withdraw money from the country. And it's again the same feature in places like Ghana. And again, that is a feature that can come in and drip out of the asset class. So again, capital can be locked up. And of course, the asset class is, I suppose we did see that in unrelated to perhaps the frontier markets, but we did see a very large regime change in Afghanistan this last weekend. Afghanistan's not within the asset class, but you do see this type of events as a feature within the frontier market. So again, political risks are there, regime shifts are there, and it's a feature that needs uncovering within your financial assessment. And another part of the risk assessment that you would want to look at for frontier markets is, of course, is credit risks. And here we just have a nice breakdown of the credit risks that's associated with the developed markets, in other words, the markets that are held within the World Government Bond Index. And of course, the emerging markets, so the JP Morgan Index, the GBI-EM Global Diversified Index. And then finally, the countries that we find in the FTSE index that Analia described earlier. And clearly there is a ratings distribution. The average rating within frontier markets is BB+. So clearly at the bottom end of the scale for the government markets that we're looking at. So again, another feature for default risk, for example, and something that people would need to consider within their overall financial analysis. So moving on to perhaps a way of how we could manage that risk, and Colchester is known for managing government risk and currency risk, and actually our approach to managing the risks within the frontier markets are absolutely no different. We believe the valuations that you might want to produce for countries like the US, for example, or even Mexico within the higher quality emerging markets, or even in the frontier markets, are exactly the same. So for bonds, we would look at the real yields, and we forecast inflation for that real yield calculation. And we acknowledge there's typically an association with countries with higher yields and those countries that have higher returns. So that's how we tend to look at valuations within all of the global government bond markets. But we also think that there is value in uncovering financial risks and ESG risks. So of course, within the frontier markets, these are particularly relevant. We want to uncover some of the balance sheet risks that we've already discovered on an individual country. And of course, when countries are particularly poor, low levels of income, ESG risks are considerably higher. So that's part of our valuation framework. And it's much the same framework for valuing currencies, but of course we do use a different valuation tool. So here we look at real exchange rate analysis. You could call that purchasing power parity analysis. And quite simply, we're using the same valuation adjustment to the nominal exchange rate to find a valuation. And of course, we would prefer to buy cheaper or undervalued currencies within our portfolios. Just like we do on the bonds, we have a financial and ESG analysis. It's slightly different for currencies. We're looking at things like current account, or breaking down the balance of payments for each individual country. And with that, we would also wanted to see any supporting features for that currency, so things like international reserves. And finally, the last thing that we would want to look at are things like short-term real interest rates. So the higher interest rates typically lead to better returns for those currencies. So it's no different. We still look at these markets in the same value-oriented way. It's just obviously the different set of countries that we're looking at. At Colchester, of course, we would be looking at those higher real yields. So we wanted to satisfy ourselves that when we're looking at this opportunity set, that we could effectively look and find a higher returning countries. So in order to do that, we have a simulation. We do this for all of the asset classes in which we invest. So the grey line there is quite simply the equal weighted version of the Frontier Markets Index that we've talked about from FTSE. And the blue line is the top 3 real yielding countries from that universe. We've actually used known inflation rather than our inflation forecast for this study. In other words, there's no forecasting bias from Colchester. And we've used hedged returns at each month end. So in other words, what we're doing each month end, we're applying the 3 highest real yielding bond markets, applying a hedged return to it, and seeing if there is an excess return. And of course, the blue line, we have found that we can derive an excess return above the benchmark. So we're quite happy with that study. And we also did the same study on unhedged returns. And the reason for that within the frontier markets, the currency hedging is quite expensive within the universe. So typically we hold our bond and currency positions closer to one another. So what we thought we'd do is look at the unhedged returns and again apply that 3 highest real yielding philosophy to the study. And of course we have generated a high return, but you can see 18% nearly on our study here and 7% on the index. So significant value we can extract from these markets by applying our valuation framework to the asset class. So I just wanted to mention very quickly on how we look at inflation. Of course, many of our investors are interested in that. Of course, we're seeing inflation very high all around the world, in particular in the US. And we use exactly the same approach for, if you like, forecasting inflation in the frontier market. So the first thing to say, our models are calibrated to forecast inflation between 18 months and 2 years. We find the ability of the model to forecast inflation falls roughly after the 2-year point. So that's why we are looking at 2 years. And essentially the model has 5 factors within it. So it's basically monetary based. We're looking at lagged money supply growth and credit growth as one feature. We also look at the pass-through effects from FX and from commodities. In other words, if commodities prices are rising, of course, that will be inflationary, but there is a pass-through effect from currencies that are depreciating that can generate inflation. But the key point is that each country has different sensitivities to those features, and that's what the model is calibrated for. And then the last feature of the model is a capacity term, which is looking at things like output gaps. And of course, where we can't get output gaps for many of these countries, actually, we may supplant that with things like unemployment, really Phillips curve analysis to see where a country is relative to its own potential. So that's a quick note on the model. We use those 5 features to forecast inflation, and that is very, very important to our real yield analysis for each individual country. Then moving on, with that framework, of course, we are trying to value each of the individual markets. So what's important for us, of course, is to be able to have that knowledge within the benchmark countries. And actually, the non-benchmark countries are all markets which we think we can access towards as they move towards being eligible for the index. And as you can see on the list, there's quite significant long list of countries that are moving towards that. Romania is on the other side. It's already in the emerging markets asset class. But I think the one feature that I already mentioned is that these countries, as they do develop, their issuance of their bonds does increase. Of course, that will make them more eligible for benchmark inclusion. And with that, of course, there'll be a lot more investors looking at those markets. So I think actually this is something those countries will be looking forward to do in the future. And then on the next page, I just wanted to mention probably the size of the market and the liquidity of that market. The first thing to mention is the size of the outstanding bonds within the benchmark, and at $418 billion, that is actually a lot greater size than you saw in the emerging markets when the JP Morgan index was issued in 2006. It is a significantly larger, more than twice the size of that benchmark. And actually the turnover of those bonds is very large again each day, but actually that is within a few select countries within the asset class. So for example, Egypt, as we saw on Annalia's slide, is a significantly larger market than some of the smaller markets within that universe. So perhaps that turnover figure does probably wash over the turnover that's in some of the smaller markets. And we've identified the dealing costs, the average dealing costs, for us to be able to build the portfolio, which is between 65 and 75 basis points on the bond side, and on the currency side, again, between 20 and 40 basis points for the dealing costs. In terms of the currency markets, most of the markets within the benchmark, if not all, have reasonably accessible currency forward markets. They have tenors between 1 and 3 months, and they do go up to 1 year for some of those markets. And most of those markets are fully free floating. In other words, they're not pegged to the US dollar. Some of those are soft managed, if you like. The volatility against the US dollar is a lot lower. And then finally on the page, we just have a breakdown of the maturity sectors across all of the index. And again, you can see that there is a full yield curve, but actually it's mainly focused in the, well, I would say below the 7-year sector. And that's just because it's more difficult for these countries to issue longer dated bonds. But we do recognize most of these markets do have bonds beyond 10 years. In fact, all of them have them beyond 10 years. And actually most of the markets have bonds beyond the 30-year maturity tenor. Just one note on ESG. I know we have done a presentation on ESG, and it's a big feature for the way we analyze the financial stability of each individual country. But of course, it is a big feature in the frontier markets. And again, we've mentioned some of the, I would say, the macroeconomic features of the frontier markets, lower levels of debt, for example. But of course, ESG is a very large consideration towards financial stability. And again, the engagement process that we have here at Colchester, in other words, speaking to the sovereign and the non-stakeholders within those countries, is an important part of the process. And really what we're trying to achieve by looking at the balance sheet and then the ESG factors within the frontier markets is to get a financial stability score for each country. And then we can use that to adjust those valuations. In other words, some of the real yields or some of the real exchange rates that we see within those markets are there for a reason. So perhaps for weaker countries, in other words, countries with weaker ESG standards, they have larger discounts for their valuation adjustment. I do have an example within the presentation for some of the work that we do. I'm not going to hit on every point. Here on the page, if you can see it, is Uganda. And again, it's a country that is very, very poor. It has GDP per capita of around 700 to 800 per capita, although it has changed dramatically over the last 10 to 20 years, and poverty is becoming reduced within the country, so that is significant. But the country does suffer a great deal in terms of the things that we would look at. Things like ESG, corruption is endemic within the country, so of course this is something that we would look at and create a big discount to the valuations that we see in the country. And actually, just because of its geographical location within Africa, Rwanda's nearby, Sudan, for example, it does have a lot of refugees within the country. And again, that does create financial difficulties within the country. And again, I think this chart says a lot. It's actually the population profile of the country, and that does bring some challenges. Actually, the people within the country are very young, so that does offer a great potential. Young people are able to work within the country, and obviously in the future as they develop, that actually creates an opportunity. So in other words, they can industrialize more, perhaps bring in more services within the country. On the next page, I just wanted to break down some of the individual features. The government debt, as you have already seen at a headline level, but debt to GDP within Uganda is reasonably low, especially when we bring it into emerging market or developed market standards. But it has increased, and in particular over the COVID situation that we saw last year. So we're residing at a number around about 50% of debt to GDP. And of course, with that, the fiscal balance, the spending on healthcare and other COVID-related issues is of course quite large this year. So they do need financing, they do need international investment, and that's why we're here today. And then finally, just a look in on some of those ESG factors. We've taken a weighted approach to the individual World Bank governance indicators, just to show the range of governance issues that you can see across the whole asset class. So of course, at the very top there, Costa Rica and Botswana, I would say they're probably at the top end of the universe in terms of their credit rating and the way the countries are governed. But clearly there is a scale on that. And of course, we can bring out Uganda towards the bottom. So obviously we do need to discount the country for that. And then finally, on the last page here, just as to finalize on Uganda, essentially they are an oil producing country. They do have a lot of potential, and actually a lot more potential coming online into the future. So again, although they do have fiscal deficits, the amount of oil that they have there may help them going into the future. And of course, inflation, and this is a feature for many of the, if not most of the frontier markets that we're looking at, it is reasonably better managed than it was in the future. It is relatively stable inflation in Uganda at 5%. They do have an inflation target like many of the countries within the universe. And of course, that does help stability within the country. So the way we look at financial stability, we do have a score range that goes from a maximum of +4, which would be a premium to valuations. And we do go all the way down to -8 for frontier markets. Uganda is towards the bottom end of that scale, a reasonably heavy discount at -6. So what does that mean in the context of valuation? So here we're looking at the real exchange rate of the Uganda shilling. We could be looking at any of the currencies, but this is the purchasing power parity chart. And maybe just to explain this chart, the 0 line is where we find fair value of the currency. And at the moment, you can see the currency below the 0 line is undervalued. And we do have these charts for every currency in which we look at. We also do that same thing in the developed markets and the emerging markets. And I would say one feature of the frontier markets is that currency values are closer to the US dollar because of those soft pegs that we've seen across the universe. And then finally, getting on to the full range of valuations on offer across the frontier markets. Well, some of these numbers are astronomical compared to the developed markets that we see today. So here we're looking at the 10-year prospective real yield. That's Colchester's forecasted inflation being taken out of the 10-year nominal yield for each country. And there is a range of these values. So maybe we can just think of US treasuries at -0.8 at the moment. So significantly better value, particularly at the top end here. Zambia at over 20% real yields, but actually some of the countries here, 7% for Ghana, the Ukraine at 7%. And actually Uganda has a very attractive real yield at 6.1%. We would, of course, discount that valuation because of the balance sheet and in particular, the ESG considerations for that country. And then separately, we can also value currencies. We already had a look at Uganda. And in the middle there at 4.7%, you can see that Ugandan shilling is indeed undervalued today at the end of July. But again, there is a range to the valuations. And as Colchester does in all of its programs, is that we would prefer to be invested in currencies which are cheap relative to those which are expensive. So Nigeria is significantly expensive relative to the US dollar, but also significantly more expensive to the currencies that we see on the right-hand side. So again, Zambia being one of the cheaper currencies. For example, Georgia, again, significantly cheap. And of course, Angola, after a series of devaluations, still extremely undervalued in our range of valuations. Putting that together, we can look at the weighted average valuation for the countries within the benchmark. Colchester also has managed to put together their average valuations if we were considering that in a portfolio. And of course, we do have the final valuation. So putting it together, the average real yields in the benchmark is 1.6%. And putting that together with the currency valuations, you have an offering on the asset class at 2.1%. Of course, with that range of real yields and the range of currencies, we can do a lot better than that. We can get up to nearly 5% of value. So that is an attractive proposition, a prospective real yield. And then finally, I wanted to finish the portfolio perhaps just to look at the relative correlations between the individual markets. So of course, we have looked at correlations between asset classes, which is great for asset allocators to look at. But here for active management, in other words, what we would want to do for the portfolio is look at the low levels of correlation. So for example, the average level of correlation is nearly zero between the countries within the asset class. And again, just that point is that you've got a negative correlation compared to the returns that you see in the US markets. And I think particularly the reason for that is perhaps the disparate list of countries that we have there. So for example, what does the economy of perhaps Bangladesh have anything to do with the Dominican Republic? These are very, very different economies, and hence you do tend to see those correlations being low or if not negative. So with that, I think I'll pause now and open the floor for questions.
Thank you very, very much, Mark. Thank you. Really very interesting presentation. We have a couple of questions here that we received. First of all, sorry, I will just switch very briefly to Spanish, solo para decirles que los slides sí van a estar disponibles, que les vamos a hacer llegar a la brevedad los slides con la presentación. Okay, so we have a couple of questions here. Let me organize. First of all, talking about risk management, no? Talking about risk in general. I mean, is volatility a good risk measure given the low liquidity in some of these markets?
No, I think, yeah, I think you have to look at the broad range of risks within the frontier markets quite separately. So I suppose the principal risk that we first look at as a manager is obviously inflation. You do have extremely large amount of different inflation rates. So that's the reason why we look at real yields as a starting point when we're looking at any market. And then of course, the risks within the frontier markets are probably more on the balance sheet side, I think, and the ESG side, how those countries are being governed. But getting on to your point that you've made about liquidity, I think that's actually one that we would look at when we're building portfolios. And it is definitely worth noticing that. And of course, that's the reason why we have brought the currency and the bond portfolios closer together. We normally separate those two risks. But actually, in terms of the measure of risks, we can use volatility. But we do also recognize that frontier markets can have things like devaluations, of course, where currencies are soft pegged but heavily managed. And these the reason for that perhaps are there are fewer people following these economies. Potentially the higher rates of inflation do lead to a need for adjustments on currencies. And of course, these are the features within the actual investment process that we use on all of our markets, not just within the frontier markets, to see if these markets are properly priced. So the first thing, of course, as I mentioned, is value, the valuation assessment. The balance sheet assessment, I think, is appropriate. And underlying volatility is, again, appropriate. But for risk management, finally, before we put our portfolios together, clearly we do need to have a conversation with our dealing desk, our risk team. The jump to default type of risk, and particular devaluation risk on currencies, is a feature. And we would have that discussion as we're building the portfolio. So we do have, if you like, idealized portfolios, but the portfolios we would want to build, but we do stress test those before we actually implement that.
Perfect.
Yeah.
Perfect. Regarding about the inflation, how challenged? I mean, do you have additional, or do you find additional difficulties on forecast inflation in frontier markets in order to find this real yield?
Yeah. This is a great question, actually. And I think, although the framework is exactly the same that we would want to use for any country, it's exactly the same process that we use when we're looking at the UK or, for example, the US. But yeah, I think there is a slight challenge, and that challenge will come on the data side. Data isn't as readily available as you can find within the developed markets, or indeed the emerging markets. The emerging markets has been, local currency emerging markets have obviously been running now for close to 20 years since the Asia crisis. And then, of course, what happened with the JP Morgan index and actually some of the other index providers like FTSE on their emerging indexes, what they have achieved is making a marketplace. And with that marketplace, data has got significantly better. So I would say that is a feature of the frontier markets. We are at the bottom end of that development curve. And actually, my hope, and indeed the hope of maybe this asset class, would be that this formalization of the asset class would lead to the positive outcome that data does improve. So I think that that's only the only difference that I've seen. The framework is exactly the same.
Perfect. How many index constituents have dollar-pegged rates? Does that increase the chance of the 80s style currency runs? None
of them are actually fully pegged to the US dollar. So I'm just going to jump to where you can see the full universe. So actually, we do look at quite a lot of countries. Out of the benchmark, we do have Namibia. So if we can find that, the Namibian dollar, which is overvalued here at nearly 6%, but they do have a peg, and they are fully pegged to the South African rand. And there are soft pegs. For example, in Botswana, they do look towards the SDRs. But in terms of the outright pegs in this universe, none of them are directly pegged to the US dollar. There are trailing pegs or softly managed pegs to the US dollar. In other words, the volatility is reduced, but you do see either trend appreciation or trend depreciation of those currencies, which I think is a release of the pressure valve has been released. So I think the likelihood of significant defaults, significant revaluations of those currencies is reduced as a function of that. Yeah.
Perfect. So Luis asked here regarding the potential oil production of Uganda. Do you assess it as an ESG risk also?
Yes, we do actually look at ESG across all of the resource producing countries. We have within our existing framework, actually before we started looking at frontier markets, we have a very large ESG database, and part of that database is specifically on resource and resource governance. And of course, those large oil producers, I think you probably see Angola's there, are within that universe. So of course, the things that we're looking at is not just how oil is extracted or potentially gas for those countries that do extract on gas, but importantly for us is how that impacts the financial standing of a country. In other words, is that going to bring good revenue to the country? And that's a potential for Uganda, but also how those funds are being used. So potentially off the subject of the frontier markets, potentially big questions being asked about the oil reserve funds that you might see in countries like Russia, for example, and actually in Angola as well. So resource governance is of particular interest, but we always look at that and how that feeds into the overall financial stability assessment.
Perfect. I have a question regarding here from Miguel regarding Argentina and Uruguay. I mean, for what reasons did they fail to be included in the emerging market index? But I think perhaps you can answer, of course, better than me. But I think Uruguay is an investment grade. It's not a frontier market. But please, do you have any comments on that?
I do actually. And actually, when we first looked at the frontier markets, Anavia found an old presentation where we had included Uruguay on the presentation, and she was very, very upset by that. And of course, that is, and the reason for her upset is quite right. Although the Uruguay, on many measures, you could say is illiquid, it's a smaller market. It's certainly not frontier-like in terms of its attributes. So you can look at things like the financial standing of Uruguay, or of course the many good things that you have going on in terms of the governance standards. So as you can see on the page, the Uruguay is no longer there. Argentina certainly is. Actually, if we look at the emerging universe, Argentina appeared in the emerging universe in 2017 and then was rather unceremoniously removed from that universe in 2019. Actually, Colchester, we didn't particularly like seeing Argentina going into that universe. They were still dealing with the holdouts on their dollar debt, and actually the debt to GDP levels, the fiscal work that needed to be done and still needs to be done within the country is significantly lower than what you would expect within the emerging markets universe. And that's exactly one of the reasons, if you use Argentina as a good example of that, is why you'd want to separate the two universes. When we are looking at the emerging markets universe, typically we do not look at frontier markets. The only markets that's in there is Nigeria, and that's because it used to be in the benchmark, but we didn't believe that Argentina should have been included in the benchmark at the first place. So we do not use frontier markets on our emerging market program, and we'd rather separate those and include them as their own unique asset class for all the features that I've mentioned above. So liquidity, lower credit, etc. So I think there is a distinct difference between Uruguay and Argentina. And of course, if anybody would like further details on that, we can give you the kind of the granular level of the details, things like the different governance standards and features that we look at.
Perfect, Mark. So we are just in time. Thank you very, very much for your presentation. Thank you all. Thank you, Analia. If you want to make some closing remarks, please go ahead. And then we are just in time to finish the call.
Thank you as usual, and thank you to everybody for joining. So it's lunchtime. I will just let you go. Muchas gracias.
Muchas gracias. Gracias a todos por participar. Thank you. Bye bye.
Thank you very much. Bye bye.
Gracias.